Welcome to The Explainer. Today, we're tackling a topic that, let's be real, tends to instantly raise the blood pressure of pretty much anyone who invests their hard-earned money. Yep, we're talking about the whole, sometimes stressful, but completely manageable process of keeping the profits you've actually made safely out of the IRS's hands. If you've ever felt that awful pit in your stomach when tax season rolls around, kind of just wondering how much of your own success you actually get to keep, well, you are in exactly the right place.
I mean, have you ever sold an asset, like maybe you finally pulled the trigger on that stock that was on a massive run, or you cashed out a chunk of crypto, and literally the second after you click sell, you think, wait, do I actually owe taxes on this profit? It's a completely relatable pain point. You make this brilliant financial move, the cash hits your account, and boom, you realize the IRS wants their cut. But once you understand the basic mechanics under the hood, managing capital gains tax is a whole lot more straightforward than it initially feels. So, to make this as easy as possible and really lower that cognitive load, we've got a super clear roadmap for today's explainer. We're going to walk through 5 quick steps. 1. Understanding capital gains tax. 2. Short-term versus long-term gains. 3. Calculating your taxable profit. 4. Ways to reduce your taxes. And 5. Common mistakes to avoid. Okay, let's dive into this. Section 1. Understanding capital gains tax. Right off the bat, there's a really critical distinction between wealth on paper and actual taxable cash. Look, a capital gain is literally just the profit you make when you sell an asset for more than you originally paid for it. So imagine you buy some shares for $5,000, right? The company crushes it, the value grows to $8,000, and you decide to sell. That $3,000 difference, that is your taxable capital gain. But, and this is key, if your investment jumps to $8,000 and you just hold on to it, well, that's what we call an unrealized gain. And generally speaking, the IRS doesn't tax that. The tax only kicks in when you actually make the sale. Now, you might be wondering what actually triggers this. Well, it's a pretty wide variety of everyday assets. We're talking stocks, mutual funds, ETFs, real estate, cryptocurrency, bonds, and even certain valuable collectibles. The crucial takeaway here is that this applies to a huge chunk of your personal finances. Basically, if you buy any asset on this list and later sell it for more than your original purchase price, yep, capital gains tax is going to enter the equation. Moving right along to Section 2, short-term versus long-term gains. You got to think of this as a literal fork in the road for your wealth. The actual amount of time you hold an asset entirely dictates your tax destiny here. On the short-term side, if you own an investment for exactly 1 year or less before selling it, your profit is considered short-term. And the painful part, these gains are generally taxed just like your regular income, which for a lot of us means paying a pretty steep rate. But on the flip side, the long-term side, if you hold that exact same investment for more than 1 year, it gets much, much more favorable tax treatment. Holding for just a little bit longer is literally like a financial weapon to protect your wealth. And this brilliantly illustrates exactly why. Depending on your overall taxable income, federal long-term capital gains tax rates fall into 0, 15, or 20% brackets. This dynamic right here is the number one reason so many savvy investors choose to hold their investments longer before selling. I mean, the difference between paying your highest regular income tax rate and potentially paying 0 or 15%, it's absolutely massive. All right, let's jump to Section 3, calculating your taxable profit. No, don't panic. The math here is actually incredibly simple. Figuring out exactly how the IRS views your money just relies on a very straightforward formula. First, you take your selling price. Then, you subtract your original purchase price. And finally, you deduct any eligible costs, like trading commissions or fees. So let's say you buy in for $10,000. Later on, you sell it for $15,000, but it costs you maybe $500 in selling expenses. You just take your $15,000 minus your $10,000 minus your $500, and that leaves you with exactly $4,500. That right there is your taxable capital gain. See, the calculation is really that straightforward. No advanced calculus required. So, now for the fun part. Section 4, ways to reduce your tax. To actually keep more of your own money, successful investors rely on a handful of totally legal, actionable strategies. First up, like we just talked about, hold your investments for more than 1 year whenever it makes financial sense. That unlocks those sweet lower long-term rates. Second, you can use a seriously powerful tool called tax loss harvesting. Basically, if one of your investments loses money, you can actually use that loss to offset the gains from a winning investment, which shrinks your total taxable profit. It's like a silver lining to a bad trade.
Third, contribute to tax-advantaged retirement accounts, like certain IRAs or employer-sponsored plans. Investments inside these accounts can grow with incredible tax advantages depending on the type. And finally, don't let taxes solely drive your decisions. You always want to consider your big picture financial goals before making a sale just for the tax perks.
Which brings us to our final stop, Section 5, Common Mistakes to Avoid.
Even seasoned investors fall into these traps all the time. Mistake number one is assuming every single sale is taxed exactly the same way. Remember, that short-term versus long-term line makes a huge difference. Mistake two is forgetting to keep records of your original purchase price, which, trust me, makes calculating your actual profit an absolute nightmare down the road. Mistake three is a massive unforced error, selling an asset literally days before reaching that critical one-year holding period, accidentally triggering a way higher tax bracket. Mistake four is just ignoring your capital losses instead of strategically using them to shrink your tax bill. And the absolute biggest pitfall, waiting until tax season to start planning. If you're waiting until April to think about this stuff, it is already way too late to change the moves you made last year.
So what does this all mean for you? Are you planning ahead to keep the profit you've earned? Because planning ahead is absolutely the best way to save your money. As we've seen today, you only pay when you sell for a profit. Holding for over a year is basically your best friend. And keeping solid records is for sure non-negotiable. I really hope this leaves you feeling empowered, confident, and honestly a little eager to go check your own investment timelines so you can keep more of what is rightfully yours. Thank you so much for joining me for this explainer, and we will catch you next time.